The human mind abhors a vacuum. It detests randomness. Faced with the chaotic dance of market prices, we desperately seek order. We search for patterns, for rules, for anything that might give us a sliver of predictive power. This desire is understandable. It is, perhaps, a survival instinct honed over millennia. Yet, in the realm of finance, this instinct can lead us astray. We see faces in the clouds and constellations in the stars. We also see trends and cycles in market data, where none may truly exist with the certainty we crave. The market is a complex adaptive system full of feedback loops and emergent properties that defy simple linear explanation. One such seductive concept is that of the fractal pattern. A fractal, in its purest mathematical sense, is a pattern that repeats itself at different scales. Zoom in and you see the same fundamental structure. Zoom out and the larger form echoes the smaller components. Think of a coastline or a snowflake, or the branching of a tree. Each part, however small, mirrors the whole in some fashion. The allure of applying this to markets is obvious. If markets are fractal, then perhaps understanding a small price movement could unlock the secrets of larger trends. This is a powerful idea. It whispers of underlying order. However, we must tread carefully. The market is not a perfectly formed geometric object created by a divine mathematician. It is a messy, human-driven arena swayed by fear, greed, news, and a million other unpredictable inputs. To say a market is fractal is an approximation, a model. And all models are wrong, though some might be fleetingly useful. The danger lies in mistaking the map for the territory. We might find repeating shapes, yes, but are they genuinely predictive? Or are they merely artifacts of our pattern-seeking brains, like finding familiar shapes in the random crackles of static? The quest to find these self-similar structures in financial time series is ongoing. Traders and analysts pore over charts looking for these repeating motifs. They hope that identifying a small, nascent pattern will allow them to foresee its larger, more profitable iteration. This is the core appeal, the idea that the market's DNA is encoded in its smallest fluctuations, waiting to be deciphered. But the market is also a master of disguise, capable of generating sequences that look like patterns, but are in fact born of pure chance. Distinguishing true structure from statistical noise is the perennial challenge. So what do we mean by market fractals in this noisy environment? They are typically defined as specific sequences of price highs and lows. A common simple representation involves a series of 5 consecutive bars or price points. For instance, a bearish market fractal might be a high point surrounded by 2 lower highs on either side. Conversely, a bullish fractal would be a low point with 2 higher lows flanking it. These are the supposed building blocks, the atoms of price movement that, when combined, form larger structures. They represent small turning points, momentary shifts in the balance of buying and selling pressure. The identification of these market fractals, however, is far from an exact science. It is deeply subjective. What one trader sees as a significant high or low, another might dismiss as mere market noise. The degree of the fractal, how large a price swing it represents, is also open to interpretation. Are we looking at 5-minute bars, hourly bars, or daily bars? The patterns will appear different at each resolution. This subjectivity is a critical weakness. If the basic units of your analysis cannot be consistently and objectively identified, then the entire edifice built upon them becomes shaky. We risk fitting the data to our preconceived notions. Consider the inherent randomness. Even a purely random walk can produce sequences that look like these 5-bar fractal patterns. Our brains are wired to find such structures. The challenge is to determine if these observed fractals are more frequent or more meaningful than what chance alone would produce. Without rigorous statistical testing, which itself is fraught with peril in non-stationary market data, we are essentially relying on visual intuition. This is a dangerous game. When real capital is at stake, the market has a way of punishing those who see signals where only noise exists. Therefore, while market fractals offer a conceptual framework for breaking down price action into smaller, potentially repeating components, their practical application is fraught with ambiguity. The desire to see order can lead to the discovery of fractals everywhere, much like a paranoid individual sees conspiracies in every random event. The very act of defining and searching for these highs and lows is an imposition of structure onto a system that may operate by different, or perhaps no discernible rules at that level of granularity for predictive purposes. It is a human construct, a lens, and the image it provides may be distorted. If market fractals are the perceived turning points, then market vectors are often described as the directional movements between these points. Think of them as the lines connecting the dots, the highs and lows that constitute the fractals. A vector represents a sustained move in one direction, an impulse of buying or selling pressure that carries the price from one fractal point to the next. These vectors are, in a sense, the building blocks of the trends and corrections that we observe on price charts. They are the raw expression of market energy, pushing prices up or pulling them down before the next minor consolidation or reversal occurs. These vectors, much like the fractals they connect, can vary in length and duration. A strong, impulsive vector might cover a significant price range quickly, indicating a powerful consensus among market participants. A shorter, more hesitant vector might suggest uncertainty or a weakening of the prevailing momentum. Analysts try to read these vectors for clues about the market's underlying strength or weakness. Is the current upward vector longer and steeper than previous upward vectors? This might suggest growing bullish enthusiasm, or is it shorter and shallower, hinting at exhaustion? These are the questions traders ponder. However, the concept of a market vector, while seemingly straightforward, also carries its share of interpretational baggage. Defining the precise start and end of a vector relies on the accurate identification of the fractals themselves, which we have already established is a subjective exercise. A slight shift in how one defines a high or low can alter the perceived length and slope of the vector. Furthermore, what appears as a single coherent vector on a daily chart might resolve into a complex series of smaller up and down vectors on an hourly chart. The scale of observation profoundly changes the nature of these apparent building blocks. Ultimately, market vectors are simply a way of describing past price movements. They are descriptive, not inherently predictive. While a series of strong upward vectors might create a compelling narrative of a bull market, it provides no guarantee that the next vector will also be upward. The market has no memory in the way we often imagine. Each moment is, to a large extent, a fresh roll of the dice, influenced by a confluence of factors that may or may not resemble the past. Attributing too much predictive power to the character of past vectors is another way we can be fooled by the illusion of discernible order. The fractal flow strategy attempts to build upon these concepts of market fractals and vectors. It posits that market movements, or flows, exist and interact across different timeframes or fractal degrees. Imagine a large river representing the primary market trend. Within this river, there are smaller currents and eddies. These are the flows on shorter timeframes. The idea is that these flows, from the very short term to the very long term, are all expressions of the same underlying fractal nature of the market. They are supposed to influence each other, with larger degree flows generally dictating the direction of smaller degree flows. According to this hypothesis, a trader's goal is to identify the direction of the dominant flow on a chosen time frame and then look for entries in harmony with that flow, perhaps using smaller degree fractal patterns as triggers. If the daily chart shows a strong uptrend, a large-scale upward flow, then one might look for bullish fractals and upward vectors on an hourly chart to initiate long positions. The smaller flows are expected to eventually resolve in the direction of the larger, more powerful flow. This offers a seemingly logical approach to filtering trades and aligning oneself with the perceived path of least resistance in the market. The complexity, of course, arises in accurately identifying these flows and their hierarchical relationships. How does one definitively determine the dominant flow? Markets often exist in periods of consolidation or choppiness where no clear directional flow is apparent on multiple time frames. Furthermore, flows can change. A strong uptrend can weaken and reverse. The interaction between flows at different fractal degrees is not always a simple case of the larger dictating to the smaller. Sometimes significant pressure building up on shorter time frames can precede a shift in the larger degree flow, much like small tremors can herald an earthquake. The fractal flow strategy, therefore, while offering an appealing mental model, requires considerable judgment and is susceptible to misinterpretation. It relies on the assumption that these flows are real, discernible phenomena rather than post hoc narratives imposed on price action. The market can generate patterns that appear to confirm such a strategy for a period, only for it to fail spectacularly when the underlying dynamics shift. The idea of nested, interacting currents is powerful, but discerning their true direction and strength in real time remains an immense challenge, akin to predicting the exact path of every ripple in a turbulent pond. Section 5. The Mirage of Precision. Fractals for entry and exit. One of the primary claimed benefits of using fractal analysis in trading is its purported ability to help identify more precise entry and exit points. The logic follows that if one can identify a confirmed fractal, say a bullish fractal low, a low surrounded by two higher lows on each side, this might signal a temporary cessation of selling pressure and the beginning of a potential move upwards. This fractal low could then be used as a reference point for entering a long position, perhaps with a stop loss placed just below it. Similarly, a bearish fractal high might be used to initiate a short position or exit a long one. The appeal of such precision is undeniable. Traders constantly seek an edge, a way to improve their timing and reduce risk. Fractal analysis seems to offer a structured, rule-based approach to this problem. By focusing on these small, repeating patterns, the hope is to catch turns early or to confirm the continuation of a move. For instance, if a market is in an uptrend and pulls back to form a bullish fractal low on a shorter time frame, this might be seen as a buying opportunity, an entry point aligned with the larger trend but triggered by a smaller scale pattern. This layered approach feels sophisticated. However, the market rarely offers such clean signals without a catch. The formation of a fractal is by its common definition a 5-bar pattern, a lagging indicator. The low point of a bullish fractal is only confirmed 2 bars after it has occurred. By this time, a significant portion of the potential move may have already happened, especially in fast-moving markets. This lag can erode profitability and increase the risk of entering a trade too late. Furthermore, fractals form constantly. Many, if not most, of these patterns will lead to insignificant moves or outright false signals, resulting in losing trades. The challenge then is not merely identifying fractals, but filtering them, determining which ones are likely to be meaningful and which are just noise. This often involves combining fractal signals with other indicators or contextual analysis such as trend direction, support and resistance levels, or volume. But this adds more layers of complexity and subjectivity. The dream of a simple mechanical system based purely on fractals for pinpointing entries and exits often dissolves into the messy reality of discretionary decision-making. The precision offered by fractals can be an illusion if not tempered with a healthy dose of skepticism and robust risk management. Section 6. The Observer's Trap, Fractals, and the Circle Paradox. The circle paradox provides a useful analogy for understanding some of the challenges inherent in fractal analysis, particularly concerning scale and perception. Imagine trying to measure the circumference of a circle using a straight ruler. If your ruler is very long relative to the circle's diameter, your approximation will be poor. You might only touch the circle at 2 points, vastly underestimating its true length. As you use progressively shorter rulers, your measurement gets closer to the true circumference as you can approximate the curve with more segments. At an infinitely small scale, you would theoretically get the true value. This illustrates how our measuring tool or our observational scale affects what we perceive. In fractal analysis of markets, our ruler is the time frame or the specific definition of the fractal pattern we are using. If we look at daily charts, we see broad swings, larger fractals. If we zoom into 1-minute charts, we see a multitude of smaller fractals, a much more jagged and complex picture. The patterns we identify are a function of the scale we choose. A smooth uptrend on a daily chart might look like a chaotic series of sharp rallies and pullbacks on an intraday chart. Which scale reveals the true nature of the market? The uncomfortable answer is that all of them do, and none of them do exclusively. This dependency on scale is critical. A fractal pattern that seems significant on a 15-minute chart might be completely invisible or irrelevant within the context of a weekly trend. Traders can easily fall into the trap of curve-fitting their fractal definitions to match recent market behavior on a specific time frame, only to find that the pattern loses its supposed predictive power when the market regime changes or when viewed on a different scale. The market's fractal-like behavior, if it exists in a strong sense, means that patterns of buying and selling, of greed and fear, may play out similarly across different magnifications, but identifying the operative scale at any given moment is far from simple. The circle paradox, or more aptly the coastline paradox when discussing natural fractals, reminds us that there's no single correct way to view or measure a complex fractal-like system. Our observations are conditioned by our tools and our chosen level of detail. What appears as a clear signal at one resolution can be noise at another, or part of a larger contradictory pattern. This inherent ambiguity means that while fractal analysis can offer intriguing perspectives, it doesn't provide a magic lens that reveals a single, objective truth about future market direction. The observer is always part of the equation, shaping what is seen. Section 7. Whispers of change, fractals and potential reversals. One of the more compelling applications of fractal analysis is in the attempt to identify potential market reversals. The core idea is that the completion of a fractal pattern, for example, a bearish fractal high forming after an uptrend or a bullish fractal low after a downtrend, can signal a pause or a shift in the prevailing momentum. These patterns are seen as the market taking a breath, a point where the dominant forces, buyers or sellers, momentarily lose control, allowing the opposing side to make a mark. This momentary shift, if confirmed by subsequent price action, could be the nascent stage of a more significant turn. Consider a market that has been trending upwards strongly. As the uptrend matures, buyers may become exhausted or sellers may become more aggressive at higher price levels. The formation of a bearish fractal high, a peak flanked by two lower highs, could be one of an early warning sign. It suggests that the upward thrust was not sustained and that selling pressure was sufficient to create a lower high immediately following the peak. This doesn't guarantee a reversal, of course. The market could simply consolidate and then resume its upward trajectory. However, it provides a point of interest, a potential crack in the trend's armor. The utility of fractals in spotting reversals is often enhanced when combined with other technical concepts. For instance, if a bearish fractal high forms near a known major resistance level, or if it is accompanied by a divergence on an oscillator like the RSI or MACD, where price makes a new high but the indicator fails to do so, its significance might be considered greater. This confluence of signals can give traders more confidence that a potential turning point is at hand. The fractal provides the specific pattern, while the broader context lends it weight. Yet we must remain cautious. Markets are notorious for false dawns and head fakes. Many fractal reversal signals will fail. A bearish fractal might form, only for the price to break above it and continue the uptrend with renewed vigor. This is the nature of probabilistic systems. Fractal analysis, in this context, is not about predicting the future with certainty. It is about identifying junctures where the probability of a shift in momentum may be slightly higher than usual. It offers a framework for managing risk around these potential turning points rather than a crystal ball for seeing them with perfect clarity. Section 8, the trader's burden. Wrestling with converging flows. The inherent complexity of markets means that relying on any single indicator or pattern, including fractals, is a path fraught with peril. Market movements are not driven by one simple fractal flow, but by a multitude of interacting flows across various time frames and participant groups. Imagine numerous currents in the ocean, some on the surface driven by wind, others deeper, driven by temperature and salinity, all colliding and merging. This is akin to the market environment where short-term speculative flows, long-term investment flows, algorithmic trading and news-driven reactions all intermingle, creating a turbulent and often unpredictable picture. A trader attempting to use fractal analysis must constantly make judgments about which fractal degree or which flow is currently dominant. Is the strong upward thrust on the 5-minute chart merely a brief correction within a larger downtrend evident on the daily chart? Or is it the beginning of a genuine reversal in the larger trend? These are not easy questions. The collision of market flows at different fractal levels creates ambiguity. A bullish fractal on a short time frame might be overwhelmed by a powerful bearish flow on a longer time frame, leading to a failed signal and a losing trade. This is where the trader's skill, experience, and perhaps even intuition come into play, though intuition itself is often just pattern recognition honed over time. There are no hard and fast rules for perfectly deciphering these complex interactions. One trader might give more weight to longer-term fractals, filtering out the noise of shorter time frames. Another might specialize in very short-term fractal patterns, attempting to scalp small profits from minor fluctuations. Each approach carries its own set of risks and requires a different mindset. The market does not offer a simple instruction manual. The burden of interpretation is significant. Recognizing a 5-bar fractal pattern is simple. Understanding its true significance within the broader maelstrom of market activity is exceptionally difficult. This complexity means that mechanical systems based purely on fractals often struggle to adapt to changing market conditions. The trader must constantly assess whether the observed fractal patterns are genuine signals of underlying shifts in supply and demand, or merely random fluctuations in a sea of noise, amplified by the very act of looking for them. This judgment is the art that accompanies the supposed science of fractal analysis. Section 9. Beyond naive signals, the fractal filter for divergence. Simple technical indicators like divergence on an oscillator often disappoint traders when used in isolation. For example, a classic bearish divergence occurs when prices forge a new high, but an oscillator like the RSI or MACD fails to confirm this new high, instead printing a lower high. This is supposed to signal waning momentum. However, in strong trends, divergences can appear multiple times, giving false sell signals while the price continues to climb relentlessly. The market seems to mock these naive signals. This frequent failure underscores the need for a more nuanced approach, a way to filter out the noise. This is where fractal analysis can theoretically add value. By incorporating fractal concepts, one can attempt to refine these divergence signals. For instance, instead of acting on every simple divergence, a trader might wait for a confirmed bearish market fractal to form after the divergence has appeared. The hierarchy of trading signals becomes important here. The divergence is a warning, but the fractal break or formation is the potential trigger. This layering of conditions aims to reduce the number of false signals and improve the probability of identifying genuine turning points rather than minor hesitations. Advanced techniques like fractal reversal divergence or fractal hybrid divergence attempt to formalize this integration. These are more complex constructions, looking for specific sequences where divergence aligns with particular fractal setups across potentially multiple time frames. For example, a fractal reversal divergence might require not just a price indicator divergence, but also a failure of the price to break a significant prior fractal level, adding a structural confirmation to the momentum signal. These methods try to build a more robust case for a potential trade by demanding more evidence from the market before committing capital. However, even these more sophisticated applications are not foolproof. They add layers of complexity, which can sometimes lead to paralysis by analysis. The market remains a master of deception. While filtering signals through a fractal lens might improve their quality, it does not eliminate uncertainty or the risk of loss. These advanced techniques are still tools, not oracles. They offer a framework for interpreting market behavior, but the ultimate success depends on disciplined application, rigorous risk management, and an acceptance of the market's inherent unpredictability. The illusion of control is a dangerous one in trading. If you found this video helpful, make sure to subscribe to the channel for more professional trading tutorials and market analysis. Got questions or topics you want us to cover? Drop your requests in the comments below. We love hearing from you. Thanks for watching, and until next time, trade smart and stay profitable.